The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A middling end to a monster month that leaves investors with more questions than answers. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bosstick.
And I'm Scarlet Fu. We're kicking you off to the closing bell here in the U.S. What's next? Sell and go away? Are we done?
I don't know. Can I sell for the rest of the year and just go away until like 2028?
As long as the uncertainty remains, right? All right, let's get a check on where markets stand right now. The S&P 500 losing 0.25%. Stocks under pressure here on renewed signs of trade tensions between the U.S. and China. Of course, some data did prove to help limit some losses. We'll get into that shortly. You have food and staples holding up better than the rest of the market. And of course, this comes on the heels of Costco's latest results. So the safety sector is still very much in play here. We're also looking at 10-year yields. Little change right now, 4.41%. But treasuries are on track for their first monthly loss of the year. And the dollar not moving a whole lot today. It is a Friday, but the dollar has closed out every month this year with a loss. So that is the worst or longest streak in about 5 years, Romaine.
We're going to talk a lot about, of course, the monthly gains and monthly losses here. May really was, though, a great reminder of the dichotomy here, the resiliency of U.S. financial markets. But this week, a great reminder of the fragility that still remains. In fact, all of the gains from this month's 5% rally in the S&P, that came in the first 2.5 weeks of the month. Since then, the S&P has been range-bound and now slipping about 1.5% since May 19th, with half that percentage loss coming from today's slide alone. Now, a core reason, of course, for the pause in this rebound rally can be summed up by one word: uncertainty. That's the drinking word game of 2025 so far, a game that got more complex after yesterday's court rulings on Trump's tariffs, today's report on broader restrictions on China tech, and tonight's political rally to tout a Nippon-U.S. steel deal that nobody seems to have any details on.
Uncertainty is the theme for the market, and we think it's going to start to become a headwind for equities here. But when we look at the equity market, we see more risks on the downside than the upside.
And making the market calculus even harder is the debate over whether all this chaos in Washington actually is having a real economic impact. Remember, yesterday's GDP revisions did seem to suggest yes. So, too, did today's trade data that showed a record plunge in U.S. imports. But then you had tame PCE inflation data this morning and a better-than-feared earnings season, Scarlett, that says, well, maybe not.
Yeah, so lots of question marks here. And as you point out, it all comes back to that lack of visibility for the people who are actually running businesses. Since the start of April, S&P 500 companies have used some form of the word uncertain or uncertainty about 3,100 times, 3,132 times to be exact, during their earnings calls and other events. That's according to a Bloomberg analysis of transcripts. And that tally, by the way, is the highest in any quarter, surpassing the early days of COVID in 2020. And if you go even farther back, even the global financial crisis in 2008. And now that the fate of so many White House policies are being litigated in the courts, the one certainty remains is companies are unlikely to get much clarity in the near term.
Absolutely. Here, let's kick you off to the close here on the final trading day in the month of May. Lara Castleton is U.S. head of portfolio construction and strategy at Janus, Henderson. And Lara, I really love those types of charts, Scarlett. It's why I love Bloomberg, frankly, because it really is data driven. But the problem that we've run into over the past few weeks is that the data all seems to be conflicting with other data. And I do wonder, as you sort of chart your path forward for the rest of the year, do you have any sense of clarity? I want to use the word certainty, but maybe some sort of semblance of clarity about where things might go next.
Well, I think we're already 3 shots deep in this first 2 minutes with the word uncertainty, Romaine. So I think that's exactly as you put it. The problem here is that we cannot really surface the meaningful data because of the headlines. For May, we actually got a reprieve from some of the tariff headlines. It is becoming very clear that June, that is going to come back with a vengeance. And that's therefore clouding, I think, some of the actual constructive data that's under the backdrop. You mentioned today, PCE coming in softer. Investors don't care about that softer print of PCE. They don't really care about the softer CPI print from earlier this month or strong employment data. Tariff uncertainty is going to be the headline, but it is extremely uncertain and unpredictable. So investors really do need to focus on underlying trends that are beneath the surface.
I am curious about this idea of American exceptionalism that we were talking about and then, of course, poo-pooing for quite a few weeks now. And we should be point out, when we look at the monthly numbers now, of course, that sort of 5-month streak that we had of the U.S. underperforming the rest of the market, that came to an end in May. And I do wonder if investors are a little bit more comfortable with what's going on here in the U.S. Yeah, sure, everything's still unresolved, but maybe people have gotten a little bit more comfortable with the chaos and how to navigate it.
Well, clearly, I think that is the case. But then again, you see the headlines today where tariff uncertainty is coming back with China with a vengeance, and you're seeing a hit to the U.S. stock markets today. So the worry of mine is that back in May, we got to valuations within U.S. equities that were almost back to where we were at the beginning of the year. And so if you actually look through April, previous to this past month of May, there were less than 5 companies of the top 50 performing global companies that were the top performing winners outside in the U.S. So the majority were outside of the U.S., but investors have about an 81% concentration to U.S. equities. To your point, with May, tariff headlines subsiding, there's strong equity earnings in the U.S., so it does not mean that investors need to abandon those good quality companies. But valuations and fundamentals are going to matter. And quite frankly, outside of the U.S., there were already transitions happening pre-Liberation Day for why investors were looking to rotate outside.
Absolutely. And your CEO has made the point back in mid-April to late April, about a month ago, that the firm could see about 10% of clients' exposure or AUM reallocated from U.S. assets because of this fraying of the idea of U.S. exceptionalism. How much of that do you think we've already seen so far?
So I actually do think that we've started to see a little bit of a trickle from ex-U.S. investors reshoring their assets back home. So you've seen a lot of the flow trades coming mostly in from Europe, where those investors who may or may not have had an overweight to U.S. stocks are now like, let me bring some of those assets back home. The clients that we're talking to are, I can't tell you how many calls I've had on international, probably more than I've had in the past 5 years in total. So they are now contemplating and wondering that. I think that there's a lot more of that transfer of assets to come as you continue to see the uncertainty and volatility. And clients are looking for where valuations are more reasonable. Ex-US, especially with the fundamentals and spending and potential deregulation abroad, is going to be a good place to search for that.
And as people debate whether U.S. stocks should be something that they overweight or underweight or go back to neutral on, one thing that there seems to be consensus around is that the dollar is weakening. How does the weaker dollar play into where people want to be exposed or how much they want to be exposed to the U.S. versus, say, overseas like in Europe?
I think that's a great point. A lot of clients, unfortunately, that were allocated ex-U.S. hedge that currency risk because that was the play that you wanted for the past 5 years. That clearly has not been the winning trend this year. So currency is extremely unpredictable. The dollar has clearly been on a trend downwards. That's what the administration, part of what they want is to have a weaker dollar, but then part of what they want is also to maintain that strength in the reserve currency. So there are some dichotomies happening within what the dollar could do going forward. I think what's important is for investors to think if you're investing abroad outside of the U.S., it is for a particular reason. It is for diversification and for different beta than what you can get from the U.S. markets. Allowing a manager that is active and can manage that currency risk for you is going to be crucial to maintain that.
And just to wrap this up, Lara, we're basically at the tail end of earnings season. We've got basically, 90% of the S&P is out there. We've seen what they had to say. Better than expected, certainly, with regards to the quarter that was. Obviously, much more of a mixed bag in terms of the forecast and the guidance that they gave. Do you think that some of those companies will have more confidence to give more concrete guidance when we get to the next earnings season in about 3 months?
Look, I hope so, absolutely. I think in general, volatility is going to continue, and that is becoming the norm, as you mentioned at the beginning. So companies will adapt to this environment. And at the very baseline, it gives credence to shift from passive investing of the past decade to active investing, where you can find the companies that, whether their guidance was cloudy or muted, they still may have better margins and opportunity for growth, whatever comes.
Lara, I'm going to leave it there. U.S. Head of Portfolio Construction and Strategy over at Janus, Henderson, kicking us off to the close here on this Friday afternoon, the final trading day of the month of May, with stocks on the back foot despite a relatively strong month. As we move forward here on the big program, we're going to focus on the macro uncertainty, and we're going to focus on the AI trade, a conversation up ahead with the CEO of NetApp.
Meanwhile, Bank of America says one company could see massive momentum even in this economy, and that's Netflix. Jessica Reif Ehrlich, senior media and entertainment analyst at BofA, joins us to break down her recent price target increase on that stock.
And we're going to get the skinny on whether the wellness and beauty industry can actually weather the current economic climate. Lauryn, Bosstick, no relation, the founder of the beauty brand The Cine Confidential. She's going to be joining us in the next hour. You don't want to miss that. This is The Close on Bloomberg.
Several of today's data releases paint a picture of the U.S. consumer tapping the brakes in April. Inflation-adjusted personal spending slowed down to a gain of just 0.1% after increasing 0.7% in March. While imports, they slumped almost 20%, leading to a narrowing in the U.S. merchandise trade deficit in April. Here now to contextualize what all of this data signals is Jennifer Lee, senior economist and managing director with BMO Capital Markets. Jennifer, great to speak with you. Is the hard data starting to show the weakness that the soft data had been really signaling for the past couple of weeks?
Hi, and thank you very much for having me on today. I'm going to say no. This is another reason why one can never look at one piece of data and just make assumptions on that, and especially now when things are very noisy. I think we have to look at all the data now with sort of like a big grain of salt. We saw, for example, as you mentioned, the trade data, record plunge in imports, but that's because we saw a huge jump back in January and in March as well, where everyone was like front loading, getting as much stuff as they can, when they can, while it's available, and while the prices were still at a reasonable level. So this is just some give back that we saw in earlier this year. So I'm not too concerned about it as well. And then, of course, the personal income numbers we saw. Yes, real spending was up only 0.1%, but that followed a 0.7% jump in the prior month. The fact that they still managed to rise, I think, is quite noteworthy. And if anything, it shows, I think, the U.S. economy overall, and I say this now, seems fairly resilient given all of the headwinds that it still faces, but we're still moving along.
Yeah, we're still moving along. And I guess that resilience also shows up in the fact that inflation has not picked up in any meaningful way because of all the tariffs, threats and tariff impositions. Why is that, Jennifer? Are we at a point where we can say that we're safe on the inflation front?
Not yet. Actually, that's a great question, and I don't know if I have a complete answer to that. I mean, I actually was one of the people that thought that we're going to see a big jump in inflation, and maybe it's because we haven't seen a lengthy period of tariffs just yet, and there are also, other ways potentially of getting around it. So a lot of companies, from what I understand, have actually again been front loading, so they got everything at a lower rate, so they're not exactly pushing through the prices at a fast pace just yet. So we're going to have to see how this, again, unfolds over the next few months. Now, given the fact that we have this new 90-day pause, so there are 3 dates that we have to think about. Okay, July 8th, July 9th, and August 11th. So those are the end dates of all these pauses for potential tariffs between the U.S. and China, U.S. and EU, reciprocal tariffs, whether or not they're legal or not, that's another story. But so you're going to probably see a lot of front loading, which means that the data now are going to be a lot noisier. Yeah. So we're going to see how this plays out, see what happens after those dates, and see how, again, the economy reacts.
With regards to just the idea of consumer spending holding up, I am curious about how that folds into the labor market. We get another jobs report next Friday, and I know there's been a lot of talk about the resiliency we're seeing there. And I know a lot of the sentiment and the survey data does seem to have a direct link to the employment picture, and more importantly, how consumers view their job security.
Absolutely. I mean, we're still seeing job growth overall, and things are slowing, and that's, to be completely expected. But the jobless rate is still fairly low at just, over 4%. We still have, over 7 million jobs available out there that are still open. They're still available to be filled. And that, I think, is also critical. Employers, as we've seen in some of the ISM surveys, have noted that they have cooled the hiring, but they're not letting go of anyone just yet. So I think that's important to note. And it's important to note that wages and salaries are still rising at a steady, I think it was like 0.5% for 3 months in a row. Mm-hmm. As long as consumers have a job, have a steady income, they're putting a little bit aside for a rainy day, which we saw with a uptick in the savings rate. Yeah, I think it's very key for the outlook. And they don't have to spend it all at once, so that's not a bad thing. Yeah. As long as they have enough and they're comfortable to spend later, I think that's a good thing. And this is what's helping keep the U.S. consumer resilient for now.
With regards to the stability of the economy going forward, and I know we focus a lot just on what consumers are spending, how trade, imports, exports factor into that. There are a lot of sort of other elements of, let's just say, foreign policy right now in this country that we know potentially could have a drag, whether that, of course, is what's going on with the universities and the blocking of foreign students. That has economic impact, whether it's farmers not necessarily being able to get the labor that they need for the upcoming harvest season. That has an economic impact. Is that something that you've started to try to model, or is it too early?
I think it's difficult to model because a lot of this, again, is just talk. We've seen some of it play out. But for example, when you're looking at some of the cutbacks in the public sector, and of course, at the beginning, it would be like, okay, so job growth is going to slow meaningfully because of all the cutbacks in the public sector. We saw people reportedly getting the pink slip and saying they're gone, and then another letter following up saying, please come back. So much uncertainty, again, because of that. And I think that's one factor that could potentially and probably is starting to hold back consumer spending a little bit. We're not sure whether or not we have a job in the next few months, especially in the public sector. Hold off, put a little aside for the rainy day, and let's just see what happens.
Jennifer, you're joining us from Toronto, so you're away from the groupthink that tends to set in when you're all in one big city like New York. I'm wondering, from your corner in Canada, what you see differently about the data that perhaps your peers in the U.S. don't necessarily see.
So we might be, and maybe I should speak on behalf of myself, but sometimes I'm a bit hesitant to believe everything I see, and this is why I always say that we have to take a handful of months, at least the last few months, roll it all into a 3 or 4 month moving average to see again what the trend is. But at the same time, there's something to be said about being on the ground in New York City, as you say, or California, to see what you're seeing. At the same time, the surveys mean a lot as well. We're all looking at the same surveys. We're all reading the same respondents from the survey, from those participating in the survey. And I think it shows, broadly speaking, that the U.S. economy is still continuing to hold up. It's just going to depend on how all these policies play out, whether or not they can play out. Again, tariffs, whether or not they're legal or not. We're going to see how that plays out.
Yeah. All right, Jennifer, great stuff. Jennifer Lee, Senior Economist and Managing Director with BMO Capital Markets. And, of course, next week we do get a slew of economic data, hard data, if you will, the ISM, as well as S&P PMIs, and, of course, that big jobs report on Friday. I think we get durable goods and a few other things in between.
Yeah, it's the culmination of a lot of jobs reports in between the more high-frequency ones. And, of course, so far, the data seems to show the U.S. economy holding up much better than anyone had anticipated. All
right, we turn back to the public markets here as we count you down to the closing bells. And we're going to take a look at actually one of the best performing stocks of the year. It's Netflix. We're going to talk to Jessica Reif Ehrlich, Senior Media and Entertainment Analyst over at BofA. She just upgraded her price target in a big way. That's coming up next here on The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Airbnb. Truist cutting its say short, downgrading to sell from hold, trimming the price target to 106 from 112. The analyst says, quote, soft summer leisure trends, both here in the U.S. and Europe, not being fully anticipated by investors. Investors, though, shrugging it off. The shares fractionally higher on the day, and the shares, we should note out, still moving higher on the week and on the month. Rockwell Automation up next. An upgrade over at Barclays to overweight and a price target boost to 350 from 283. Barclays saying that the maker of industrial sensors will show an improvement alongside a rebound in factory orders for new automation equipment. Those shares headed towards their best month since July of 2022. And last up, BRP, the Canadian maker of Sea-Doo watercraft, seeing a wave of analyst upgrades after its earnings yesterday, including from Stifel. Stifel upgrading to hold, increasing the price target to 68 Canadian bucks, up from 49. Stifel saying that the company is on its way back to growth mode. The shares growing by almost 10% here on the day, headed for its best month since April of 2020. Another big performer out there in the marketplace is Netflix, one of the best performers year to date among large cap names, trading at a record high today. And Bank of America sees room to run, raising its price target to $14.90 from $11.75, implying more than a 20% upside over the next 12 months. unmatched scale and streaming. That's a big part of that call, and the analyst behind it joins us now. Jessica Reif Ehrlich, senior media and entertainment analyst over at BofA Securities. All right, this has been, to me at least, it was kind of a surprise kind of stealth rally in these shares, but I'm starting to get it. Looking at these past couple of earnings reports, I'm curious, Jessica, as what you see the growth trajectory for the next couple of earnings reports and beyond.
Yeah, I mean, it has been, as you said, it's been an amazing performance of 33, almost 35% year to date. But we see a lot of drivers for it to continue to outperform. There's clearly room on subscriber growth globally. But the really big driver will be advertising over the next, call it 5 years plus. Mm-hmm. This is a revenue driver that they have not really had before. They started in Canada. They just introduced the U.S. in April, and they have 10 more markets coming online within the next few weeks. So those 12 markets represent 85% of global advertising revenue. Also, more than 50% of new subs are coming in on the AVOD or advertising tier. Mm-hmm. So they're scaling up. They clearly have content that people are watching. So they're scaling up. They have engagement. They have more viewers, and they're innovative. And it's a completely new business. So regardless of whether the advertising market is strong or tepid, this is incremental.
It's incremental. I get what you're saying, but in looking at your new price target, $14.90 would represent a 24% jump from current levels. What's going to be the catalyst that gets us to that point? Because it's not a steady climb up at that point. You're talking about jump conditions.
Well, basically, it's Netflix's current multiple on 25 just rolled forward a year. So it's a kind of I'd say rich multiple at 40 times, but we believe that the company, the risk is to the upside because you have a new business in advertising, which will double this year, granted from a low base, but should grow. They're only beginning to scale up in second half 25. Yeah. And 26, it really scales. And then, there's just, it's pricing, it's sellout. It's more people, more engagement. And so but what drives engagement? It's content. Yeah. Normally, as an analyst who's followed media for decades, I'd say it's really hard to predict what shows or what movies will do well. Yeah. But in this case, that second half will be strong because they have 3 of the biggest shows ever coming back. They have the final
Squid Game, right?
They have the final season of Squid Games. They have second season of Wednesday. And then they have things like Bridgerton and Emily in Paris coming back, which are highly popular. So,
what about Happy Gilmore? What about Happy Gilmore 2, Jessica? I mean, that to me, that is Happy Gilmore 1 is a classic. Happy Gilmore 2, I feel should be in the pantheon of the greatest movies ever made.
Exactly what I don't predict. Unknown, so I won't go there. Could do great, could not. I just don't know.
All right, Jessica, thank you so much for joining us. Jessica Reif Ehrlich, senior media and entertainment analyst with BofA Securities. What do you know about Happy Gilmore 2 that the rest of us don't know?
I don't know, but I love Happy Gilmore 1. And, I go in with pretty low expectations for any Adam Sandler movie. So it's like, you just go in to laugh. And, I like potty humor.
I feel like expectations are pretty high just based on Happy Gilmore's opening montage alone.
Yeah. I think it's going to be fantastic. And, it'll keep me tethered to the Netflix platform, at least for a few more months.
I know, and you don't even watch any TV either, so that's the amazing thing. All right, coming up, we've got a conversation with George Kurian.
I watch this show.
He is CEO of NetApp to discuss the company's latest earnings results and how AI is transforming his business. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bosstick.
And I'm Scarlett Fu. And earnings season is winding down. I mean, we're at the tail end with retailers all but done. But we do have some big ones next week.
Yeah, there's still kind of one big one, and that's Broadcom. I mean, NVIDIA, of course, was really the capstone here. And everyone was talking about the AI trade, how much juice was left in that. NVIDIA, I think, gave us a little hope that maybe it is. We're here for Broadcom, obviously, a chip maker. But they make a lot of stuff that, of course, is part of that AI ecosystem. And we've heard from a few other companies also in that ecosystem. And it's been a mixed bag. But overall, it seems to suggest that there's still growth there.
Yeah, and in fact, analysts are looking for Broadcom semiconductor sales growth to reach a 2-year high on the back of that AI computing demand. So we'll see how that all shakes out. When it comes to technology, there's that big divide between hardware and software. NetApp is a company that offers both hardware and software-based storage solutions to companies overall. And its CEO, George Kurian, joins us now. George, thank you so much for joining us on Bloomberg Markets, The Close.
Thank you for having me.
So,
good afternoon.
Good afternoon. Your latest results, both for the quarter that ended and for the full year outlook, suggest that companies are being fairly cautious in their IT spending. By contrast, I'm wondering how much conviction they are showing when it comes to their adoption and their spending on their AI build out.
We just completed a record year across every element of our P&L, from top line to bottom line to earnings per share. And it was powered by the growth of our big bets. Our all-flash portfolio grew well ahead of the market. Our cloud portfolio also grew strongly, 44% year on year. And our AI infrastructure solutions grew fivefold year over year. We are seeing the shift in the AI market from getting ready using technologies to train AI models to now applying those AI models to drive business impact. And that's what powered our record quarter and year.
When it comes to the spending on IT by your clients overall, though, I'm wondering if you could share a little more color on that. Clearly, they want to put their money to the highest impact to get the most effect. But I'm wondering, are they delaying their IT spending, or are they actively slashing their IT budgets overall?
We saw strength in our business in North America and in Asia Pacific. We saw a note of caution in US public sector, particularly in the federal segment. And we saw a hint of caution in the large manufacturing and export-based economies in Europe. These are primarily related to some of the macroeconomic uncertainty that exists in the market.
How much, though, I mean, when we talk about, George, the exposure to macro conditions and the idea that a lot of CapEx spending, particularly when it comes to AI and AI adjacent projects, that spending seems to be much more structural and much more long term. How much can you count on that, though, over the next few months?
Within our business, we saw the strategic projects like AI projects, cloud transformation, cybersecurity continue to get priority even in a relatively muted spending environment.
So when we get to this idea, George, of the expansion that we're seeing in that space, and to a certain extent, and just to be fair, we should point out there are some companies that have either pulled back or at least put on pause any increases in spending. But overall, when you talk about the hiring of CIOs, when you talk about the migration to the cloud for a lot of these projects, I do just wonder where NetApp fits into that broader ecosystem.
Yeah, AI is a combination of chips, semiconductors like NVIDIA's, large language models, and data. And we are the data part of the AI market. We hold the largest amount of corporate data in the world. And what clients depend on us is to use that data with these large language models so that they can apply AI to their business. And that's where we're seeing really strong growth.
Thank you for explaining that. You mentioned your customers, including in the public sector, especially at the federal level, as well as manufacturing companies in Europe, are the ones that are showing a bit of caution. I see also that you have universities as your client base as well. What does that look like, given the pressure that a lot of schools are now under with the pullback on government funding, in some instances in the U.S., and I'm sure in other parts of the world, a willingness to spend because they have a once-in-a-lifetime opportunity to gain market share?
It hasn't rolled through the university system yet. I think many of our clients still have grant monies left over that they're using. We'll have to wait and see what the impact of some of the pullbacks on, government research funding has over time.
Understood. I'm also looking at your M&A profile on the Bloomberg terminal. That's the BUYP function here on the Bloomberg. And it shows that it's been a while since you made any acquisitions. The last one I see here is from 2022. What's your strategy when it comes to M&A?
We do small tuck-ins that help bring more value to our platform. We have the world's best data infrastructure platform, which we have built over many years, and we buy tuck-ins like, for example, enhancing the cybersecurity of our platform to improve the privacy and governance capabilities in our platform. We don't do large adjacent market acquisitions.
All right. So what's kind of the future, though, long term, George? And I mean this not so much just in the context of acquisitions and things, but we've talked a lot on this program about how challenging the environment is. We're obviously going through some huge geopolitical shifts. We're going through huge industrial shifts as well. And we talk about this idea of what it takes to be a CEO in this environment, the idea that you're not just a manager, you're not just a visionary, you're to a certain extent a diplomat, if not a babysitter. I am curious how you hold up in this environment on a personal level, and whether, and forgive me for phrasing it like this, whether this is the job you signed up for.
I think you have to build resilience into your business system and your organization and to yourself. We've done that over many years. We, for example, struck joint ventures to give us access to markets that are less accessible to American firms. We have built resilience into our supply chains so that we are not exposed significantly at all to these tariff situations. And we've built capabilities in our organization to remain agile, to operate as one team in such an environment. And then personally, I think, listen, you just have to be, balanced. When you have a great year like we did, you got to stay humble and focused. And then when times are tough, you got to work on how you can do better.
All right, George, we're going to have to leave it there. Really appreciate you taking time for us. Give my best to Pamela. George Kurian is the NetApp CEO on the heels of that company's earnings just last night. When we come back, we're going to pivot from tech and back to consumer spending. Shares of Red Robin having a phenomenal day after reporting earnings that outperformed expectations. We're going to look ahead to some of the big earnings reports coming out of, a few other companies in the restaurant space as part of our Stock of the Hour. That's coming up next here on The Close on Bloomberg. Time now for our Stock of the Hour. Taking a closer look at shares of Red Robin, up almost 70% on the day after the burger chain reported earnings. Now, we should point out store traffic was down, but comp sales were up. So too were margins. And there was a lot of optimism about some of the idiosyncratic issues going on with that company. Our next guest says that he actually sees a little bit more life when it comes to sales in the restaurant industry. Michael Halen over at Bloomberg Intelligence joins us right now. And Michael, you saw those results out of Red Robin. We got a few other restaurants over the last couple of weeks, and we get Cracker Barrel next week. I am curious about the state of how much consumers are spending at these places, what store traffic is looking like, and whether you expect those trends to continue.
Yeah, listen, traffic's been down, but not too bad. In April and some of the weekly data we have for May shows some growth, right? So average check growth is outpacing the traffic decline, and so we're seeing some growth, right? I think there was a freak out over the tariffs, right? I think this was something that you'll see a lot from the New York-based investment crew, right? Like their own personal accounts are taking a hit, and so they extrapolate their own pain to the rest of the country. But most people don't have personal accounts. They have small 401ks, and they're not really interested in the fluctuations of the stock market, and they still have to go out to eat, right? And so restaurants don't have as much tariff impact as a lot of other industries. I think restaurants are kind of insulated largely from the tariffs, and I think investors are coming back into the space because of that reason.
And investors are seeing that consumers and customers of these restaurants are staying fairly loyal. This is a sticky group of people that want to stick with their preferred restaurants. We hear a lot about companies launching these loyalty offerings to make sure that stickiness remains. Shake Shack being the most recent. How much does it cost to launch these kinds of programs? What is the downside of it for the companies?
Well, yeah, it's expensive, and historically they haven't really worked all that well. So a lot of the technology restaurant chains have invested in the last handful of years haven't provided great ROIs. And so what we see, the companies that we see taking share, because that's the environment, right? Like the industry isn't growing gangbusters, right? So companies that are doing a good job are taking share from the companies that aren't. And the companies that are doing a good job are first focusing on operations, getting those nailed, right? And then they're turning on the marketing, increasing their marketing spend to get people in the door. And that's the formula that's working. That's what we're seeing at places like Chili's and Cracker Barrel and Shake Shack. And, you know, it's just old school running restaurants.
Is there any growth story when it comes to these restaurants? And I mean, in terms of expanding footprint, or are most of these companies and their CEOs just kind of protect what they have, make sure they get folks in the door, and then I guess at some point in the future, maybe next year, they can start thinking about expansion?
Net unit growth is always a part of the story. They got to keep their Wall Street investors happy. But chains are growing at different rates. So Wingstop is one that comes to mind. They're talking about growing their store base 16 to 17%. That's largely going to be franchisee driven, right? Those stores have great cash-on-cash returns, around 70%. So people are lining up to open those stores. They're going to open them up basically as fast as they can find the real estate. Other sectors of the industry, like casual dining, which is having a nice little renaissance here this year, are just trying to stabilize their store base. There's been some closures over the last couple of years, and they're trying to improve their cash-on-cash returns and returns on investment so that, you know, they can get back to growth maybe next year.
Okay, so very much sounds like a, stick to your basics and then also steal market share when you can. Michael, really appreciate you joining us. Michael Halen of Bloomberg Intelligence. And of course, Romain, he says that he thinks Cracker Barrel and Shake Shack can outperform Cracker Barrel reporting earnings next week. Yeah,
I love Cracker Barrel. I wish they would put one like somewhere like in Manhattan so I didn't have to go out to the real America. I'm scared of real America. But I love that store, by the way.
I bet you like the general store, right? That's the part
my wife always makes fun of. I spend more time in the store than I do actually
the gummies, right?
Table.
You're into that.
They got everything. They got all the old school candies.
Yes,
Sarah.
they do.
Come on.
Or as Gen Xers, we love it.
Tannuzzo coming up next. This is The Close. Welcome back to The Close. Just about 10 minutes to go here in the trading day, Friday afternoon. And we should point out also, of course, the last trading day for the month of May. That, of course, is having a little bit of an impact on the market action. Romain Bosstick here with Scarlet Food. Yeah, we're seeing a little bit of a melt up in the final hours of trading here. Maybe there's some window dressing before the end of the month. But worth noting here that you look at some of the sub-indexes, the NASDAQ, little change at this point. But the Golden Dragon Index, all those Chinese companies are definitely falling because of concerns that the U.S. is going to impose more restrictions on Chinese companies by specifically targeting subsidiaries of Chinese companies. And in addition, you see the semiconductor index, the Philadelphia Semiconductor Index off by 1.8%. Yeah, but safety still remains the play here with consumer staples. Right. So on China, though, I mean, we talk about this idea of kind of getting a reminder that a lot of these trade issues still are far from resolved. And I think, of course, the news that, starting, of course, with the court rulings, but really coming into today, Trump saying basically China's not holding up its end of the deal. And then, of course, this Bloomberg report saying that you might see those broader restrictions. Yeah. And that's something that the market is going to have to contend with, right? The idea that, things are better probably today than maybe what they were in early April in terms of the rhetoric. But again, we talk about loose ends. When do those loose ends get tied? I don't know that they do, and that's just something everyone's going to have to learn to live with. All right. Well, you're still seeing a bit of flight into safety, though we should point out, at least on the day and on the week here, that is not the trade. A little bit more bullishness, certainly compared to what we saw coming out of April. Gene Tannuzzo joins us right now. He's global head of fixed income over at Columbia Threadneedle Investments. And we should point out, Gene, with this monster rally that we're seeing here for U.S. equities in the month, we're kind of seeing the flip side when it comes to treasuries. A lot of folks deciding, okay, maybe I can sort of whittle away some of those positions I built up. I am curious as to whether that is something that you're seeing happen on a broad scale, or if this is really just some trimming, some tactical repositioning that could easily shift back in the other direction, depending on what the president has to say over the next few weeks.
Yeah, thanks a lot, Romain. I think it really is more short-term repositioning. What we've seen this year is really bonds and stocks move in more opposite directions, more of the traditional correlation that we're used to over years. But that's a correlation that was very challenged during the high inflation, rising interest rate period of 2022 and 2023. If I look at this month, for instance, as you talk about, yes, the bond market's been weaker. Treasury yields are higher, but the S&P 500 is up 6% on the month. So actually, I think that bit of diversification is coming back from a client demand standpoint, we're actually still seeing increased demand. And if we look at, for instance, the investment grade market with yields of 5.5% to 6%, that's still pretty compelling in a world where, we saw this morning inflation's just over 2%.
You mentioned investment grade. You're talking about corporate credit. I am curious what the spreads right now are telling us, because we never really got that massive blowout in spreads back in April when the market was freaking out. I mean, I know they did widen, but it was nothing like we saw during past crises. And I know they did narrow a little bit. What are those spreads telling you right now, that differential?
Yeah, the corporate credit market is telling us that corporate investors are not particularly concerned about volatility in the market or trade uncertainty. We saw credit spreads widen 30% or more through the worst of the April tariff noise, and we've retraced at least 2/3 of that in most sectors. So I would say the market is pretty relaxed, and we find that to some degree a little bit concerning, given we've seen a lot of resurgence of recent tariff fears just in the last 24 hours.
So where do you want to be within the world of fixed income when you look at it in terms of corporate credit, MBSs, bank loans, sovereign debt?
Well, look, we think because diversification is working better, a balance of duration risk and credit risk does make sense. So it's not time to run completely away from credit. But if we look at the duration side, we like intermediate maturities. We think the 5 to 10 year segment is pretty attractive, given the Fed is absolutely in a position of strength with real interest rates well above inflation and room to move rates lower as we get into the second half of the year. We would still be very defensive on the 30-year part of the curve. I think we're going to hear more about fiscal concerns as we get into tax talk, as we think more about this big, beautiful bill. We want to complement that intermediate treasury duration with credit exposure in the mortgage market, the loan market, a little bit of investment grade credit, but quite frankly, as we already mentioned, that market's gotten pretty expensive.
Has the bond market started staking out positions, pricing in what they think the final bill, the law will look like, or is it still way too early given that the Senate hasn't even gone through it yet?
I think it's too early, honestly. We're not seeing a lot of industry differentiation based on the tax bill at this stage. We're concerned that in some form of what the House has proposed, one of the things we're seeing is a tax on foreign investors owning U.S. bonds, particularly corporate bonds. We don't think that would make its way to the final bill through the Senate and ultimately into law, but if it did, that could be very troubling. So we're definitely watching that sort of thing. It's not evident in the market pricing yet that the market is particularly concerned about those sorts of things.
So when you hear people talking about bond vigilantes, and I remember we were speaking, I think it was last week with Leon Cooperman, who kind of scoffed at that idea, basically saying that he's never met a bond vigilante. But it gets to this idea of whether we're just kind of creating these narratives in our head, particularly with the comments by Jamie Dimon today about the potential for some pushback from the bond market, specifically with regard to what's coming out of Washington.
Well, I think the concern more recently has been about foreign investors abandoning treasuries as a safe haven asset. And if you read the minutes from the Fed, this week, that really wasn't a concern of theirs through the market participants that they talked to. Now, could domestic participants be sellers to drive term premium higher? Well, we've seen that. And that, over a long period of time, you can't really correlate treasury yields with deficits. But we are seeing increasing frequency and increasing magnitude of treasury investors getting very concerned about the size of the deficit and just the size of these auctions, which are unrelentingly growing. I think we'll see a combination of more instances of this type of volatility and the Treasury Secretary deciding how to manage those maturities and maybe pull them in a little bit.
Just real quickly, Gene, I know we still got about 2.5 weeks or so before we get to the next Fed meeting, but what are you expecting to hear? I know we're not going to get a change in rates, but what are you expecting to hear?
Well, I think we want to hear more about the labor market. I think really inflation is something that the Fed has put to the side, and we can look at where CPI and PCE are printing, and quite frankly, it's pretty good right now, but it could get very noisy as potential tariffs come in, and the Fed's going to really shift, I think, to a singular focus on the labor market. And remember, last year in the summer, the unemployment rate rose by 0.3%, and that was enough to get the Fed very worried and cut by 50 basis points when they got to September. So commentary around even jobless claims today, anything around the weakening hiring survey data, and if that's getting them concerned, that's important.
One final question, Gene. You're walking down the street. There's an Olive Garden, an Applebee's, a Cracker Barrel. Which one you picking?
I mean, Cracker Barrel's got the store and the food, so you got to go 2 for 1.
I like it. Gene Tannuzzo, one of the best in the business, global head of fixed income with Columbia Threadneedle Investments, helping us count you down to the closing bells. Scarlett, stock's basically not doing much of anything today, fractionally lower on the day, despite a pretty strong gain on the month.
Yeah, Treasury is also higher as well, pushing yields somewhat lower. And of course, the concerns over the fiscal picture certainly remain, keeping a cap on those yields.
A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bosstick alongside Scarlett Fu, taking you through to the closing bell. Joining us right now for our global simulcast is none other than Jess Menton. Alex Steele has the day off. Oh, and there is Carol Nasser as well, as we welcome our audiences across our Bloomberg platforms,
Are you feeling
television,
outnumbered,
radio,
Romaine?
our partnership with YouTube, Jess Menton, here on a momentous end of the month here, last trading day in the month of May.
I mean, I'm going to let Jess put it into perspective, but I'm just going to say for the month, I'm just looking at
Not now, though, right? You're going to...
In a second.
Oh, okay.
I'm going to set her up. I'm going to tee her up. The major industry groups in the S&P 500, 10 of the 11 are higher. Infotech up about 11% for the month overall, Jess.
All right, and just looking at the size and scope here, S&P not only on pace for its best month since November 2023, but if you look at it, up over 6% this month. So basically, it's about to notch its best gain for May specifically since 1990, holding on to this right at 4 p.m., guys.
Do you know what I said? I asked if she was born back then. I was like...
I definitely was alive in 1990.
You're so seasoned, you know the markets, but I was just curious.
So this raises the question of what happens next. I feel like we've run out of some immediate catalysts. We're waiting for progress on the big, beautiful bill. We are waiting for the Fed, of course, but they're not going to do anything. We're waiting for the jobs report, but it's all going to be fairly incremental. What's the next catalyst?
Well, you have, of course, obviously that big Fed meeting. Don't forget all of these dates when it comes to Trump's tariffs, which I've been trying to catalog all of them, and it's kind of dizzying. And don't forget also, guess what? Congress, or at least the Senate, coming back from vacation and now going to deal with that big, beautiful something.
That'll take a while.
We'll see if they can deal with that. But the market for right now, taking it in stride. Fractional gains and losses across the board on the day. But that really belies what was a relatively strong week and an even stronger month of May. The Dow Jones Industrial Average is going to finish out the day only fractionally higher by, we'll just call it about 0.1%, but it's still sitting on a sizable gain of about 4% for the month of May. The S&P 500 unchanged on the day, but adding about 1% on the week and more than 6% in May. The NASDAQ Composite down 3%, 0.3% on the day, but 10% for the month. The NASDAQ 100 up 0.9%. And as far as your small and mid caps go, we should point out the Russell 2000 fractionally lower on the day, but it did add about 5% in the month of May. The S&P equal weighted index adding about 4% in the month of May, and the mid caps, Carol, adding about 5% in the month of May.
Yeah, pretty significant. All right, folks. And if you look at the S&P 500 in today's session, kind of an even split, some bouncing around in terms of the overall index. But Scarlett, you've got 259 names to the upside, 243 to the downside.
All right, let's take a look at the IMAP and show you how it breaks down in terms of the 11 sectors in the S&P 500. And two groups finishing up by better than 1%. Consumer staples and utilities, those are your classic defensive sectors. It's where investors go to when they seek shelter and seek some stability. Communication services ending with a 0.5% advance. As for the sectors in the red, energy lower by 0.75%. Consumer discretionary and tech also in the red.
All right, a lot of red and green there. Let's get to some individual gainers. Ulta on that list, up more than 16% at its highs today, finishing the day with about a 12% gain. Intraday it was up, I think, the most since 2020. Number one gainer in the S&P 500. The company coming out, boosting its full year profit outlook. And it also talked about comp sales were also higher than expected, and talking about the last quarter. And analysts kind of flagging some of the strong execution at the company.
I'm absolutely fascinated by this. I mean, because remember yesterday you had Elf rally like
Yes.
20-something%, also in the beauty space here.
Yes.
Is this the play?
I don't know.
Yeah.
I think when people are feeling a little crunched, they call this what? Kind of a small little spending you can do to kind of get some pleasure. So
something to make you feel good.
Yeah. Yeah.
That doesn't cost. That doesn't necessarily cost a whole lot
luxury.
to do here.
Yeah. Right?
Yeah.
Like, but some of this stuff's expensive, so I don't know what a little luxury it is. Costco. Let's also stay in the retail space. This is the number 4 gainer in the NASDAQ 100, folks, up about 3%. Company posted third quarter earnings per share that beat the average analyst estimate. Company talking about navigating some of the tariffs out there and the economic turbulence by flexing its scale and devoted following it. It is looking at some potential price changes on its item-by-item basis. So,
Scarlett. Yeah, you know, it was so funny. I was looking at their earnings report, and you look at the growth rate. Did you know that like 6 percentage points of that growth rate was from the Scarlett Fu household?
I believe it.
Yeah.
I buy in bulk for everything.
She does.
Also, Lisa Mathieu on the surveillance. She's there, I think, regularly. E-commerce sales were growing about 16%. Hey, one more, Palantir Technologies. This is the number 2 gainer in both the S&P and the NASDAQ 100, guys. It's up almost 8% in today's session. This after the New York Times reported that the Trump administration has expanded the data analysis software companies' work across the federal government in recent months. By the way, Palantir has received more than $113 million in federal government spending since the president took office. This again, the New York Times reporting, citing some public records. All right, Jess, over to you.
Moving over and looking at those decliners, as Carol is talking about too. So I'm going to start off with Gap, ticker symbol GAP, because it dropped actually 20%.
Aren't you glad they finally changed their ticker, Jess?
It's actually much easier now, so I appreciate that. And also down, so 20% loss. I mean, this has erased its gains for the year and also its worst day actually since early April. So that, maybe not surprisingly, unfortunately came as that tariff hit warning that it gave it weakness at its smaller brands, when it's talking about some of those other ones too. Banana Republic is one of them too, but they talked about how it could have an impact as much as $300 million from that tariff impact, and revealed some of that stubborn weakness there. Moving over and looking also at the biggest decliner though in the S&P 500, Regeneron, REGN is the ticker symbol, down 19%, its worst day since April 2011 there. So this actually came after a drug trial missed the mark here, in 2 late trial drugs here, experimental, specifically when it's going on and not meeting those goals as far as what's happening there. And Sanofi also had as far as when it's looking at its smokers' lung drug trial data, unfortunately coming in not as good as expected. And then wanted to end on contact lens maker Cooper Companies, ticker symbol COO. That actually was the second worst performer in the S&P 500, down almost 15%, worst day since November 2008. That actually came after it cut its outlook for organic growth for the year. And the company, even though it reported better than expected earnings results for the second quarter, but did see a guidance downgrade, and also specifically by JP Morgan, guys, so that's pressuring the shares.
Hey, pop quiz for you, Jess. So Regeneron, second biggest decliner in the S&P 500 in the month of May. What was the number 1 decliner?
In the S&P 500 for this month, let's see. I don't know. It surprised me.
United Health.
United Health, of course.
Of course.
You can use the MOV function and look at it on a making basis.
I'll always be selling, Jess. Yields. No, that's me. Sorry. I'm always looking for Alex Steele, who's, of course, has a well-deserved day off here. You take a look at the yield picture here. Slight moves lower here on the day, but we talk a lot here about the first big decline that we've seen on a price basis, on a monthly basis, I should say, for the U.S. Treasury market. Of course, we had 3 straight months where we did see a rally, and, of course, that being pushed back a little bit. And, of course, we talk about that inverse correlation. Gene Tannuzzo, our guest on TV just a little while, that inverse correlation returning between stocks and bonds, a healthy sign, according to him.
All right. Don't know if there's going to be a song written about this, but big day for Taylor Swift. She has actually bought back her early albums. She has been on a crusade for many, many years, a fight with her former record label, also with music manager Scooter Braun, about the selling many years ago of her songs. And she owns the music. She wrote it, but her songs, the original recordings, were sold, and she's been trying to kind of get them back. She's also been re-recording them.
No, this is a big deal, especially for anyone who's been paying attention to those Taylor versions in recent years here. So big news coming out of this for her.
Yeah, so my question is, are we still going to have Taylor versions on Spotify and the other streamers?
That's a great question.
What should we listen to?
I don't know. Are they materially different? Somebody who doesn't listen to a lot of Taylor Swift, but I am intrigued just by the business of this, right? I mean, we talked a lot when she was doing those re-recordings as to why she even would have to do that. And we all know, of course, with a lot of these record contracts, particularly when these are young artists coming in, they kind of sign their life away and not quite noting it. And we won't get into some of the shenanigans that Scooter Braun is alleged to have pulled in that as well. But the idea that she had the clout and obviously the money to be able to sort of reclaim all of this stuff for herself, I mean, it is a victory not just for her, but you wonder if it might set a precedent for other artists out there as well.
Yeah, something Reba McEntire actually had done in the past, and Kelly Clarkson had brought it up, and I think that's what spurred Taylor Swift into doing it.
It's her property. I mean, it's her creative property, right?
I want to know what she spent. I want to know what she spent.
Yeah, I do too.
She didn't share how much she paid to, get all the ownership back, but she did say that she now controls all of her life's work. So we're talking about photography, album art, videos, and unreleased songs, in addition to the master recordings.
And she's working on a new music as well too. So, which I assume she also
2026?
I assume she also
2027.
owns.
Wait.
And I think that it's safe to say that there's some cachet from the original recordings, right? She can re-record them and re-release them, but there's something about, as she was growing in her career, right, to have ownership of that. I think there's a lot of value.
Jess, what's your favorite Taylor Swift song?
Oh my goodness. I feel like I'm going to say album instead. I feel like I do really like the Reputation album in general. I know it was a little bit different than some of her other albums, but then also 1989 I feel like is always a popular one too.
What about you, Scarlett?
I like Love Story. That's my favorite song.
What about you, Romaine?
That one where she cursed a lot on the Midnights thing, that was pretty cool.
I was taking you for a folklore kind of guy, but I guess I was...
Right, yeah.
I like Taylor. I like listening to her.
All right, guys, that's a wrap. Maybe we'll listen to some Taylor into the weekend. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Scarlett and Romaine continuing on TV, and Jess and I right here on Bloomberg Business Week Daily. We'll see you again on Monday.
Our coverage continues here on Bloomberg Television, a breakdown of what happened in the month of May and a push ahead to what may happen next. The big jobs report up ahead in about a week's time. And of course, a big focus on AI. We're going to talk about the intersection of those two things with Hayden Brown, President and CEO of UpWork. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bosstick. We end the month of May on, well, kind of a relatively uninteresting note, but it was a relatively interesting month here. The S&P 500 unchanged on the day. Most of the other major indices saw similar moves, but all of those major indices gains on the week and significant gains for the month of May. In fact, some of the best performances that we've seen for some of those indices going back to at least 2023. On the day, though, we did see softness in the semiconductor space. We did see strength in the healthcare and in the healthcare and the life sciences space, Scarlett. And of course, we're still waiting to hear from President Trump, who's going to celebrate, well, some news in the commodity space.
Yeah, we're not quite sure what he's going to say. And we're looking at U.S. Steel shares as a result. It's up 1% on the day. President Trump traveling to Pittsburgh, delivering remarks about the planned partnership, the planned deal between Nippon Steel and U.S. Steel. Last week, he described it as a partnership, but we did have today a report out of Japan indicating that the White House is making final arrangements to approve Nippon Steel's plan to buy U.S. Steel as a wholly owned subsidiary. So, again, not clear what's going to happen, but the stock is moving higher right now, or it has closed up. Palantir, speaking of connections to President Trump, up almost 8% on the day. The New York Times reporting that the White House has expanded the company's work across the federal government in recent months, according to public filings. And Regeneron losing almost a fifth of its market value in one day. At one point, it plunged as much as you can see, 19%. The drug maker disclosed disappointing data from a late-stage trial of its experimental drug to treat a lung disease. Romaine?
All right, we talk about the big month of May here. We'd be remiss in not pointing out that we came in to early April. You had the S&P trading down around 4,800, bouncing, of course, off that lows. And for the month here, you're looking at a 6% gain on the S&P 500, 9% to 10% gains on the NASDAQ indices as well. Eric Weiner joins us right now, who helps to lead our markets coverage here at Bloomberg. And we talk about that bounce, a bounce back above the 200-day average, a close back above that 5,900 level. Am I supposed to get excited now?
Well, holding that level at 5,900 was big to traders like that. And if you look at the performance in May, it's the best May we've had since 1990. So great month. And it actually, the bounce back from the April lows has been pretty impressive. But if you look at the last couple of weeks, we've kind of been treading water down a little bit. And heading into June, June is usually flat. Like historically, there's pretty much no gain. So this is usually a quiet month. And when you look at us for the year, we're still basically flat, up slightly, and we're underperforming the rest of the world. So if you're hoping for a comeback in June, history says no. The question is what the market says.
Right, and in fact, we won't get any much in the way of earnings either, because that catalyst is over for now until July. So it feels like we're all going to be trading off of trade headlines, and now that the taco trade has been articulated, you wonder whether investors are going to fall for each announcement.
Well, it was already starting to slow slowed down. We were starting to see, say, less volume and also more retail action, less Wall Street action coming from those trade headlines. So we're already starting to see some of that. But yes, there's an element of this where you can only say this so many times. You can only say, like last time with Trump, where the 2 weeks thing, and it was 2 weeks and then 2 weeks and 2 weeks. So there's a boy who cried wolf element to this, where you keep talking about it and eventually people stop listening. The real question is what the data starts showing, because I think that's what Wall Street pros are looking at. Right now, with the market being as high as it is, it's hard to jump in. If you're out and you're on the sidelines, it's difficult to find a way in. But if there's a downdraft, people will buy that dip.
Yeah, that's been proven over and over again. Eric Weiner, thank you so much. Bloomberg's Eric Weiner helping lead our coverage here of equities in the U.S. Turns out we're exactly 1 week away from the May jobs report, and all eyes are increasingly on how AI is reshaping the workforce and how employers hire. Warnings are growing on the role of AI in the labor market, with Anthropic CEO telling Axios that AI technology could soon eliminate 50% of entry-level jobs. Joining us now to discuss is Hayden Brown. She is president and CEO of UpWork. This is a platform to navigate freelancing opportunities. Hayden, good to speak with you. And there's so many different ways we can look at how AI is affecting the labor market, from replacing jobs to changing the way that employers look at candidates and sift their candidates as well. From where you sit right now, how much are freelancers being affected, contract workers being affected by AI?
Thanks, Scarlett. What we're seeing is freelancers are actually benefiting in significant ways from these AI enhancements. Across our platform, clients are actually posting new types of work, looking for different types of skills, and actually freelancers are earning more, on average 40% more, if they're engaged in AI-related work. So far, we're actually seeing this as a huge win, not a loss for freelance talent.
I am curious too, Hayden. I mean, we just got through earnings season, and going through these conference calls, I was actually amazed at how many companies were talking about how much they've employed AI for their own internal uses. So you had Intuit saying they've improved like coding by employing more AI functionality and hiring more folks in that realm. Expedia said it was helping out their marketing. Coca-Cola talked a lot about using this emerging technology to improve their creativity. So I am curious about how far this goes, and are we thinking about AI jobs in the right way? Because I know we always kind of think of them just from, say, the coding side of it, but we're seeing a lot more practical applications that aren't directly related to coding.
Absolutely. We are seeing every type of business look for talent that is AI enabled across their entire work stack. It could be in marketing, it could be in operations, it could be in technology, as you mentioned. But this is definitely not just an AI technical skills situation. We're seeing businesses of all sizes. First of all, they are not where they want to be on AI. Whether they are ahead of the curve or behind the curve, they all are trying to move faster. And the number one reason that businesses are citing problems here is access to AI talent is actually the biggest holdback for 63% of companies. So we're seeing just the early innings of what this is going to do for jobs and for the economy, but it is going to create more opportunities, and businesses are just leaning in more and more every single day.
For those who are experts already in AI, that makes a lot of sense. But those who are expected to incorporate it, how much of an expectation is there? Is there training being provided by employers, or is this something where they need to go into the job with that skill set?
Scarlett, there are big differences across the labor market on this. So what we've seen is freelancers on our platform are using AI tools at a very high rate organically, because this puts bread on the table for them. This is how they stay relevant. 63% of freelancers on our platform are using AI tools weekly. We have 80,000 AI specialists and 250,000 AI experts who are helping clients in the past year. But when we look at the freelancer population as a whole, those rates of adoption of AI are not nearly as high. And when you look at the employee populations, they're actually the lowest. So you're right that companies are going to have to reskill their populations or go to populations like freelancers to find the skills that they so desperately need.
I'm curious, Hayden, how you and your team at UpWork is using AI, if at all.
We're using it everywhere, Romaine. And I'll share, you guys were talking about Taylor Swift earlier. We've built some custom models for our team, and the team is having fun with the naming here. We've got Taylor Drift as a ChatGPT type model that actually lets us query customer support data, NPS scores, net promoter information. We have another model called Snoop Log and another one called Taylor Drift. All of these things are helping our teams move forward with AI, as well as adopt, V0, Cursor, Linear, all of these tools that are helping us in the coding realm.
In what way is AI not helping your freelancers, Hayden? Is there any area in which it simply can't replace what the old-fashioned way of doing things?
AI definitely is not replacing a lot, and the human touch is necessary, which is actually a win for freelancers, because this is where we're seeing AI is augmenting work. It's not replacing and automating all of the things that talent can do. So freelancers are actually benefiting from higher wages, more work opportunities, and they're really not seeing massive displacement in any way. We've seen marginal changes in categories like writing and translation, where automation has been happening for many years, even before the advent of ChatGPT. But on the whole, talent is actually doing bigger, more complex projects because of AI.
Hayden, what's your favorite Taylor Swift album?
I mean, I was surprised. I love Lover, and I was surprised nobody mentioned The Man as like the best song. So I'll put that out there, Romaine. I think that's a winner.
All right, Hayden, got to leave it there. Always a great conversation. Hayden Brown is the CEO and president over at UpWork. When we come back, we're going to take a deeper dive into what's going on in the world of logistics and freight. Jared Weisfeld, the chief strategy officer over at RXO, out with some interesting data here about global trade and, more importantly, about all of those products moving across the country. That conversation coming up after the break. This is Bloomberg. All right, there was this Bloomberg survey at the start of the month that showed that truckload carriers are showing greater optimism compared to where things were in the fourth quarter. About 55% of the folks in that survey say they're now expecting an increase in the rates that they charge over the next 3 to 6 months. That's a big improvement from the previous survey. Now, the truck brokerage RXO published fresh data last week showing that optimism might actually have been warranted. Spot rates did climb 9% last quarter, and contract rates, which had been in deflation and lagging that recovery, rose for the first time since 2022. The chief strategy officer at RXO joins us right now, Jared Weisfeld. And Jared, the numbers were pretty decent. Now, we should point out 9% growth was not the 11+% growth we had the previous quarter, but still, that was decent growth. And to see that catch up, or that potential catch up in contract rates, what is that telling you?
That's absolutely right. It's telling us that we're moving to the next phase of the freight cycle. We've been in a soft, prolonged freight environment for over 3 years now. So I think in line with that survey that you just showed, we're entering that next part of the freight cycle where rates are moving into inflationary territory. And we saw in Q1, spot rates were up about 9% year over year. That strength continued into Q2 to date, about mid-single digit increase. And our expectation is consistent with that survey data that you just showed, where we're actually going to see, based on the curve, which is our proprietary data set, that we believe spot rates will continue to rise for all of 2025.
What about seasonal factors? What kind of summer shipping patterns should we anticipate, and how that affects this trajectory you're looking at?
That's exactly right. And it's such a good point, too. When you look at where we are right now, approaching what's called the 100 days of summer, you look at into Memorial Day, extending into July 4th. Typically, this is a pretty robust season for food and beverage. So we're coming out of 2 weeks ago, we had what's called DOT checkpoint week, where trucks are stopped over a 3-day period and being assessed, making sure the trucks are operating smoothly, et cetera. That plays into what is typically some seasonal tightness, combined with produce season, combined with food and beverage. So I think that's exactly right, where we are now entering into Q2, which is typically a seasonally stronger quarter relative to Q1.
How reliable do you think some of those seasonal patterns will be this year in light of all the things going on with tariffs and kind of the uncertainty that causes? You come in at the start of the year, the tariff rate on average is 2%, goes up to 20-something% in April, and now, based on these latest developments over the last few days, they're back down to 6%. I mean, how are your shippers, the ones that you're brokering for, how are they handling this?
No, that's right. I mean, I think this concept of seasonality is, it really has been changed since COVID, right? So to answer that last question directly in terms of what's the mindset of the shipper right now? If I had to pick one word, I'd say it's uncertainty, right? We are in a fluid environment right now as it relates to trade policy. And where you could see typical seasonality in Q2, to your point, Roman, you got to be cognizant of other factors, notably changes in trade policy. Encouragingly, over the last 90 days, we've seen global de-escalation from a trade policy standpoint, specifically with China, UK, and potential progress with the EU. But I think that's absolutely something to watch out for in terms of can changing trade policy impact that expected seasonality.
So as brands and manufacturers look ahead to the holiday season, it is, after all, late May. What should they be anticipating in terms of the costs?
Yeah, so in line with what we were talking about earlier, our expectation is that spot rates will continue to move higher throughout 2025. I think what's encouraging is if you look over the last few weeks, even from some of the largest retailers that have reported earnings, they've talked about a pretty healthy inventory position. And we're seeing that also from our conversations with our customers. So I think retailers did a really nice job strategically planning from an inventory standpoint. But as you think about the second half of the year, the market is more balanced than it has been any time in the last 2.5 years. So there should certainly be an expectation for rising freight rates into the back half.
All right, Jared, really appreciate your joining us. Jared Weisfeld is Chief Strategy Officer over at RXO. Coming up on The Close, we'll be joined by Lauryn Bosstick. She is the founder of the beauty brand The Skinny Confidential, discussing how the wellness and beauty industry is doing given the rise in all this uncertainty. Drink up. This is Bloomberg.
All right, this is that part of the show where we really like to focus in on the entrepreneurs, the next big things out there in the market. And we got a great one for you today. From beauty blogger to podcaster to now, well, brand empire. That's the story of The Skinny Confidential. What started as a blog back in 2011 evolved into the highly rated Him and Her podcast, and now a line of consumer products as well. Pleased to say that the founder of that company joins us right now. Her name is Lauryn Bosstick. We should point out, no relation to Romaine Bosstick. Nevertheless, though, we love having you here on the program. I've been following your podcast for quite some time. I've been following your new brand of products for quite some time. I am curious as to whether you saw this evolution when you started just blogging out of college or whenever it was back in 2011, that you saw a trajectory for this, or was this kind of a happy accident?
I definitely launched the Skinny Confidential blog with the intention of building a brand. And I knew that it would take a lot of work, but it was very much a foundation to launch a book, a show, a product line, and roll it out strategically throughout the years. And it's been 13 years later. So that is what's happened. It's taken a lot of time, but it definitely launched with intention.
What was kind of the main thing that you learned along the way, particularly in between when you sort of started the blog itself, you got to that podcast, and then at some point, 2021 or whatever it was, you actually decided to really capitalize on that with actual consumer products?
I always wanted to launch consumer products, but I wanted to make sure that the audience was invested in the product. So I had to find what the white space was, and I had to find what would disrupt that white space. And what I did is I was in constant communication with my audience all the time via DM and email. And with the show, we're able to talk to them through a hotline. And I was able to sort of have the audience be like almost like investors in the product that I launched. And when I saw that the product that they wanted through affiliates and through swipe ups and through their DMs was an ice roller, I set out to make the best one on the market. And they helped me choose everything from textures to colors to how big it should be to the packaging. So when it launched, they were so excited about the product because they had essentially helped me build it. And I would not have been able to gather all that information without having the blog and launching the blog as a brand. I think a lot of businesses launch their business and then they get the community. And what I tried to do differently was I built the community, and that took, 6 years to build that community. And then I launched product. And I think moving forward, you're going to see that a lot. We just saw what Hailey Bieber did. She launched, she had her community, she grew her community, and then she launched her brand Rhodes. So I think you're going to see it being flip-flopped.
Yeah. Well, speaking of that community, I mean, we should point out that you and your umbrella company, Dear Media, you're now investing in other folks who could end up being the next, Lauryn Bosstick or whoever. Talk about that process, why you decided to sort of take your own success and, of course, double that down and bet on the potential success of other folks.
Yeah, I think that was also, starting with our own podcast. My husband and I host the Him and Her show. We started that 9 years ago. We've posted episodes 3 times a week for the last 10 years. And off that success, as it slowly got more successful, my husband identified a white space where he wanted to help other creators sort of do what we've done, but from a 360 approach. It wasn't just about launching a show. It was like, how do you support their business? And how do you support their merch? And how do you support them going on tour? So he wanted to create something that wasn't out there. All of these other podcast networks were just focused on selling advertisement. And so he sort of made this 360 approach for all these different creators. And through that, I'm a partner and he is the founder, and he's been able to really support hundreds of different shows do sort of the same thing we've done.
I'm curious if you can just kind of talk a little bit just about economic conditions and kind of saw a lot of the uncertainty going on right now, particularly for now a business that is selling actual products and having to navigate trade and consumer fears and uncertainty. How do you prepare for a cycle that we're not even really clear what that cycle will be?
I am someone, and I tell my entire team this, that whenever there's something going on like that's going on with the tariffs, you have to look at it as an opportunity. So for me, I have tried to take what's going on, and be like, okay, how can I pivot and make my business more efficient and make it better? So I think sometimes you have to sort of be woken up out of the formula. And when you're a business, you're just sort of doing the same thing day after day after day. And I think this is a great wake-up call to all business owners to maybe change their formula. And I really do think in the long run, it's an opportunity.
All right, Lauryn, well, we wish you the best of success here. A lot of people really focus in, of course, on just how far you can take this. Lauryn Bosstick is the founder of the beauty brand, The Skinny Confidential, the co-host of the podcast, Him and Her, and, of course, the umbrella media organization, Dear Media, now investing in other companies. As we close out the month of May here and we continue our coverage on the close, let's take a look at how stocks not just ended the day, but more importantly, how did they end the month. This was a big turnaround for U.S. stocks, a 6% gain on the S&P 500, but more important, keep in mind, 5 straight months, the S&P had underperformed the rest of the world. That streak coming to an end right now with U.S. stocks back on top, at least for the month of May. The big question is whether that will continue into June and beyond. Bitcoin, of course, got its mojo back, and we did see a flip-flop when it comes to what was going on in the rate space as well. When you look at some of the big individual movers, well, we were just talking to Lauryn Bosstick, the biggest gainer in the Russell 1000 in the month. Well, that was a beauty products company, Elf Beauty, gaining 82% in the month of May. You also saw significant strength, a big rebound in Tesla shares, up about 23%. But to the downside, Apple really being left out on this, and of course, United Health, a 27% drop over the past month. This is The Close on Bloomberg.
I would say that they are a bit stalled. I believe that we will be having more talks with them in the next few weeks, and I believe we may at some point have a call between the president and party chair Xi.
The White House turning up the heat on China, with Trump accusing Beijing of violating their trade agreement. This is a new survey shows Latin America increasingly taking China's side in the tit-for-tat trade war. Joining us right now to discuss is one of the brightest minds in the world of geopolitics. Shannon O'Neill is Senior Vice President and Director of Studies at the Council of Foreign Relations, and she also writes columns for us here at Bloomberg. Great to have you.
Great to be here.
You heard what Scott Bessent said there early this morning on Fox. A little bit after that, the president himself weighed in and said, yeah, it would be great if Xi would get on the phone with him, something we've heard from the president before. I am curious as to why we haven't seen more communication at a high level between the leaders of the U.S. and China.
Well, I think part of it is they're not really sure what they can negotiate. I mean, you look at what the United States wants. The United States wants, tariffs to come down, and wants China to change the way that they're, trading with the rest of the world, wants their subsidies and things to go away. While China wants access to very high-end semiconductors and other things that the United States is very hard to give. I would also say for China's advisors to Xi, it'd be very hard to put him on a phone call or in the room with Trump not knowing what is going to happen in that meeting. So I think right now, both leaders, it's very hard to bring them together because you're actually not sure what you're negotiating. And the changes on tariffs and the recent court cases and the decisions there and the injunctions and all that make it even more unclear what's going to happen because you don't even know what the tariffs on China or the United States are today.
In your view, does the U.S. know what they want?
This is the thing with the Trump administration, right? One day they want leverage over other countries. Other days they want tax revenue. Another day they want to remake the U.S. economy so that we're producing iPhones and toasters and everything here. So I think there's so many messages coming out of the United States. It's hard for China or many other countries to come to that table to negotiate because you're not actually sure what the United States is bringing to the table.
There's been a lot of talk about this idea of whether we are sort of creating this sort of bimodal world when it comes to trade. And this idea that whether other countries, not the U.S., are going to have to choose between whether they want to align themselves with the world's largest economy or the world's second largest economy in China. And we kind of framed that in the intro around what's going on in Latin America right now, some of the deals or I said potential deals that might actually be struck not with the U.S., but with China.
Yeah. So this is an interesting thing, right? You look at the last decade, you've seen lots of companies, multinationals, develop a China plus one strategy, right? They produce in China for China, but then they think about the United States or other markets from other places. And as the U.S. goes forward with these tariffs, wherever we really end up, we may see some companies look at a U.S. plus one, right? You produce in the U.S. for the U.S. because there are tariffs to protect the U.S. market. It's still the biggest consumer market in the world. But if you want to produce for other markets and those, billion other middle-class consumers that are rising that aren't going to be in the U.S. as we look forward to the next 10 years, you might produce in other places too. So I think there is a change, a shifting of where companies are thinking about. And as you say, the question is it going to be bimodal? Is it choose one or the other? Or is it, how do we think about global markets and where do you produce from?
Are some of the companies, though, and we've heard a lot of this on certain conference calls, that a lot of companies are really just standing still right now because they don't want to sort of get in that. And it also gets to the idea of reshoring manufacturing. There have been a lot of announcements, or we're going to invest this amount in the U.S. and this, that. We haven't actually seen shovels in the ground on a lot of these projects. And I do wonder if that's just the normal function of the build-out cycle or if that is because of the geopolitical uncertainty and saying, well, let's wait until we get something on paper and with regards to these trade deals.
I think that's right. You don't know really what your cost structure is right now, right? You don't know what the advantage of producing in the United States. You don't know if it's a 10% tariff from other places in the world, a 50% tariff, or what other advantages you may have. The other challenge for businesses, even if they do want to come here, is one, sure, it takes a while to build out and do those things, but the United States is at pretty near full employment. So if you're going to bring people to your company, you're taking them from other sectors. And which ones will you take from? Which ones are really the priority of you, but also the U.S. government. And that, too, is really up in the air. And in the end, if you really want to increase overall output in manufacturing, it's difficult to totally reshore. You're going to have to nearshore or at least have some other partners in this process.
Do you think that the U.S. government will provide a little bit more assistance in that? I know Trump has talked a lot about wanting to do this, but typically in the past, when we've had these sort of big cycles of investment in private businesses, usually there was a government component to it to kind of facilitate the whole process. I'm not sure I've heard anything articulated from this administration that they even want to do that or if they even were capable of it.
Yeah, we don't see a lot of investment outside. We see a lot of protections, so sticks to keep others out. So that's what tariffs are and some of those other controls. The one area we see, if you look at the tax bill that's at least gotten through the House, if not the Senate, is you see a lot of money for defense. So that is one industry where you may see a lot of government procurement, a lot of focus, and some opportunities for companies, frankly.
All right, Shannon, a really great conversation. Shannon O'Neill is the Director of Studies at the Council of Foreign Relations as we continue our conversation with a look at what's going on in Washington, particularly when it comes to trade. We should point out that Japan and the U.S. have agreed to hold further trade talks at the upcoming G7 summit in June. So potentially progress there between another of the world's largest economies. Joining us right now is Joe Mathieu. He, of course, is the co-host of Bloomberg's Balance of Power. Joe, great to have you here, in New York. I am curious about just the progress that this administration is making, because I know we hear a lot of rhetoric about what Trump wants, the pressure that he's putting on these countries. But is there real movement right now in these negotiations?
That's the real question, because we hear about framework agreements, and we also know it can take years to hammer out a real trade deal, never mind 90 of them in 90 days. But look, this is pretty encouraging. It's Japan's Minister of Economic Revitalization, who met with the Treasury Secretary Scott Bessent, Commerce Secretary Lutnick, and came out of this with pretty good things to say, generating a headline to suggest we could see a trade deal as early as next month. Now, they are going to meet again. There's going to be another round ahead of the G7 that will also feature a meeting on the sidelines between President Trump and the Prime Minister. This would be a big deal, and we're not out of the woods yet. Japan is urging the U.S. to drop the tariff regime, and we did just get a readout from the Treasury Department. It says Scott Bessent urged the importance of addressing tariffs, non-tariff measures, and increased investment. I'm guessing they talked about U.S. Steel while they were at it.
Well, let's talk about U.S. Steel. I mean, the president is, if not, they are already on his way to Pittsburgh to take a victory lap on a deal that I'm confused. Is there a deal or not? I mean, I know he said that there was some sort of partnership taking place between Nippon and U.S. Steel. There have been Bloomberg reports saying that it could actually be a full-on sale of the company. What do we know?
These are the questions that we're asking as well. Is this a takeover? And if it's not, why would a Japanese-based company sink tens of billions of dollars into the country to have no control over the company that it bought? This golden vote we're hearing about, that apparently the United States government will not only have a stake, but a real point of direction. Imagine Donald Trump being on the board of directors, if you will. That's kind of what we're talking about here. What do the workers think about this? He's going to be up, as Romaine mentioned, in Pittsburgh, just outside the city tonight, with a massive campaign-style rally, and union workers who objected to the takeover of U.S. Steel. Romaine, are they going to buy the idea of a partnership? That's what we're about to find out.
Well, you mentioned that golden share, and it's an intriguing concept because, again, it's this idea that he, or at least the U.S. government in some shape or form, would effectively have veto power over any real business decisions, right? I don't know why Nippon would agree to that, but it gets to this idea of what does he want U.S. Steel to be? Does he want it to be truly a U.S.-based company? And can we do that with a major foreign investor like Nippon involved?
Well, you know, we're about to find out, because you just kind of characterized what he said. It's a partnership that will keep U.S. Steel and its jobs here in the U.S. Outside of that, it's a massive question. And I have to admit, I'm not expecting a lot of answers tonight. This is going to be a rock'em sock'em, Trump rally. We're told he could be riffing for 90 minutes tonight doing the weave. I don't think he's going to be describing...
The weave.
Yes, that's right.
I love the weave. I love when you
how
use that
the
word.
balance sheet works might not be part of it.
All right. Well, Joe Mathieu will have full coverage of that at the top of the hour as the co-host of Balance of Power. But we do want to go out to Pittsburgh right now because, as Joe just said, the president is scheduled to speak at 5 p.m. Eastern time to tout that partnership between Nippon and U.S. Steel. Josh Wingrove, our very own Josh Wingrove, is out there in West Mifflin, Pennsylvania, thankfully inside, out of the rain, Josh. And I don't know if you heard Joe there, but there is a big question here. How much substance are we going to hear about this deal, or is this just indeed kind of a campaign-style rally?
I think Joe had a pretty good weave himself there. He's learning from Trump. I'm glad to hear it. I do think we'll, be attuned to some of the developments. We are expecting, for instance, Scott Bessent is traveling with the president. He might say something about it. Remember, Treasury Secretary leads the CFIUS panel, and a lot of the questions are there. But Joe is absolutely right. There are a lot of open questions to this. The golden share thing, remember, Pennsylvania Senator David McCormick, a Republican who talked about a golden share. It's not really clear what that means. In other cases, that typically means a share, a stake, an ownership stake. But here it might be more of a branding exercise where we're talking about powers that are typically in mitigation agreements. Those are the deals, basically the strings attached that get hashed out in the CFIUS process. So we'll look for details on that. I've been here for a few hours, so we've heard from executives, the head of U.S. Steel, the vice chairman of Nippon Steel, which has been leading their negotiations. Both treated this as essentially a done deal. One Republican congressman from Pennsylvania told me that it's as good as done, but clearly there are still some things being ironed out on this one.
Josh, have you had a chance to talk to any of the workers or just people from the community? I'm curious how they feel about this potential deal.
Yeah, so there's been a bit of a division between what's called International, Steelworkers International, which is the head of the Steelworkers Union. They have been staunchly opposed. The folks here see it differently, including some of the local presidents who've been speaking publicly in favor of that deal. And of course, That's very unusual to have public division in a union, but it just goes to show you how much they think was on the line. Our colleague Joe Doe and I were just speaking with one of them who said that they thought that this investment would provide job guarantees and that it would keep the plants open for more than just a few more years, whereas the United Steelworkers executive is worried about job guarantees and whether Nippon Steel might shut down unionized plants in favor of non-unionized plants. So these are tough choices, but I think the union members that are in particular here are on the more favorable side. They want this deal. They're showing up here to hear President Trump.
Yeah.
There are signs thanking President Trump, saying make U.S. Steel great again. So I think that side of the ledger is here, but you're absolutely right. U.S. Steel, the executive leadership, they don't like this thing.
Real quickly, only about 30 seconds, Josh, but what is the scene there? Like, how big of a venue is this? How many people are there? What types of people are there?
We are in U.S. Steel's Irving Works plant in the Mon Valley. This is basically the cradle of the American steel sector. We have steel workers behind me. You can see a lot of orange, behind me, as well as just plain old Trump supporters. This has a rally feel, so I do not think Trump will just dwell on this deal here. But much of the backdrop, you see rolls of steel products behind it, golden age signage. It's hard not to look at this and see that the White House isn't treating it as a done deal.
All right, we'll let you get back to it. Josh Wingrove on the ground there for that rally. That rally is scheduled to start at about 5 p.m. Eastern time. We will have full coverage. The Balance of Power team will be taking over at the top of the hour. Meanwhile, I want you to stick around just a little bit longer with me. I'm going to set you up for what to watch over the next week in financial markets. This is Bloomberg. This week was light on catalyst for financial markets, but that changes in a big way next week. Jay Powell, the Fed chair, has remarks that he's set to give on Monday. And don't forget that the Senate in Washington, they finally come back, and now they have to tackle that big, beautiful tax bill. On Tuesday, we get economic data, including vehicle sales, as well as some interesting earnings out of Dollar General, as well as others. Fed speak that day from Austin Goolsbee, as well as Lori Logan as well. And then on Wednesday, more Fed speak. Raphael Bosstick of the Atlanta Fed, as well as Lisa Cook. And, of course, the drumbeat begins to the weekend's big jobs report. The ADP unemployment data comes out on that Wednesday. On Thursday, in between, we do get a little bit of a breather, a focus on what's going on over there in Europe. The ECB set to make a rate decision, and we will hear from Christine Lagarde. We do get earnings from several companies, including Lululemon and Broadcom. And then on Friday, of course, is the star of the show, the May jobs report here for the United States of America.